Welcome to Talk Tickers. Normally, this is where we dissect the latest quarterly earnings calls.
Right.
We break down the guidance, operating margins, EPS beats for the companies in your portfolio. Basically, we look at the micro.
Yeah, the businesses themselves.
Exactly. But today, we are doing something totally different. We aren't looking at the businesses in your portfolio. We're actually breaking down the business model of the industry that sits between you and the market.
It is arguably the most important earnings call you will never hear. I mean, it's the earnings call for the financial advice industry itself.
Right. And this is critical because, well, we know who listens to this deep dive. You are sophisticated. You probably manage your own books, or maybe you have significant assets with a professional.
Yeah.
And you scrutinize expense ratios on ETFs down to the basis point. You debate PE ratios. You analyze free cash flow yields, dividend coverage, all of that. Mm-hmm. But there is this massive line item that often gets a free pass.
Or at least a glossing over.
Yeah, a glossing over. And that is the actual cost of the advice itself.
It is the invisible drag. And I don't just mean the invoice you see at the end of the quarter.
Right.
Because if you are only looking at the fee you write a check for, or the fee that gets deducted from your account, you are missing conservatively half the picture. There's this entire ecosystem of revenue extraction happening completely below the surface.
Because compensation structures dictate behavior. That is essentially the golden rule of economics.
Absolutely.
If you don't understand precisely how your advisor is paid, you don't actually know who they are working for.
Exactly.
So today we are stripping down the mechanics of advisor compensation. We're going to look at the revenue streams you don't see. So things like third-party kickbacks, shelf space payments.
The soft dollar economy.
Yes, the soft dollar economy and the notorious double dip of proprietary products.
And we really have to unpack the regulatory gray zones here too. Because there is a profound amount of confusion about what a fiduciary actually is versus a salesperson.
I mean, the industry has spent billions of dollars on marketing to blur those lines.
Billions, just so they are indistinguishable to the average client. So our job today is to basically redraw those lines with permanent marker.
Let's start with the core concept then. Financial advice is not a monolith.
Right.
It feels like one, You walk into an office, there's mahogany wood, a nice coffee machine, maybe a TV playing CNBC in the lobby.
Someone in a very nice suit shakes your hand.
Right, exactly. But behind that facade, there are completely different regulatory frameworks and different compensation models that directly impact what ends up in your portfolio.
It's so true. From the outside, a stockbroker and a registered investment advisor look totally identical. Mm-hmm. But the engine driving them is completely different.
And the confusion really starts with the terminology. So we have three main buckets that we need to define before we can go any deeper today.
Yes.
Fee only, commission-based, and the very tricky fee-based model.
Right, and fee-based is, well, it's the linguistic sleight of hand that catches even the most sophisticated people off guard. Mm-hmm. But let's start with the clean ones first.
Okay, let's look at fee only, because this is the term you usually hear consumer advocates pushing.
Right. Fee only is the standard that eliminates the most obvious conflicts. It means the revenue comes solely from the client, period. That is the definition.
Okay.
It can be an hourly rate, kind of like an attorney. It can be a flat retainer, like a gym membership. Or, most commonly, it can be a percentage of assets under management AUM.
So if I have, say, $1 million with you, and you charge 1%, I pay $10,000 a year.
Correct. But the key discriminator, the absolute bright red line here, is that there is zero third-party compensation.
None at all.
Zero. No kickbacks from mutual fund companies, no insurance commissions, no trails, no revenue sharing from the custodian.
Just the client and the advisor.
Exactly. The only money changing hands is between you and your advisor. It is completely transparent. You know exactly what you're paying, and you know that the advisor isn't getting some hidden bonus from Vanguard or BlackRock just for choosing their fund over another one.
Which aligns the incentives as closely as possible, right?
Yeah, it does, though we will definitely discuss some nuances and conflicts there later.
We will. So then you have the other end of the spectrum, which is commission-based, and this is the old school stockbroker model.
Correct. This one is entirely transactional. The revenue comes purely from the sale.
Right.
So you buy a mutual fund, I get a load fee, maybe 5% up front. You buy an annuity, I get a commission. You buy an insurance policy, I get a percentage of the premium.
And what if I just sit in cash?
Then I starve.
Wow.
Literally. If I don't sell you a product, or if you just hold positions and don't trade, I don't get paid at all. My entire incentive is activity or the placement of new products.
That seems straightforward enough, honestly. Most people understand that a car salesman makes a commission, you know they want to sell you a car.
Right.
But then we have the muddy middle, fee-based, and it sounds almost identical to fee-only.
And that is entirely by design. Fee-based is a hybrid model. It means I charge you a fee for advice, maybe that same 1% of your assets to manage the portfolio. But I also retain the license to accept commissions and third-party payments on the products I put into that plan.
Wait, so I might pay you $5,000 for a comprehensive financial plan? You hand me a plan that looks great?
Yeah.
But that plan requires me to buy a specific insurance product. And unbeknownst to me, you're getting a $3,000 commission on that very product.
Exactly. It allows for the acceptance of third-party money while still charging a fee. It is very distinct from fee-only, but consumers conflate the two constantly.
Because they sound exactly the same.
They do. And the industry loves the fee-based model because it provides a baseline of recurring revenue from the fees, plus the upside potential of commission spikes whenever they sell a product.
Best of both worlds.
Best of both worlds for the advisor, absolutely. But it is the most confusing world for the client.
This brings us perfectly to the regulatory divide. Because how you are paid is usually tied to how you are regulated.
Yes.
We hear the word fiduciary thrown around in commercials constantly. You know, we are fiduciaries. We put you first. It's become this huge marketing buzzword. But what does it actually mean in a hard legal sense?
The fiduciary standard is the highest standard of care under the law. It applies to certified financial planner professionals, CFPs, and strictly registered investment advisors, or RIAs.
Okay.
It means you are legally and ethically bound to act in the client's best interest at all times. You must place their interest ahead of your own.
At all times seems to be the really operative phrase there.
It is. It means if there is a cheaper, better product available, you must recommend it, even if it pays you less or pays you nothing. It requires a legal duty of loyalty and a duty of care.
So it's not just a nice slogan.
No, it's not just about being nice. It's about a strict legal obligation to optimize the client's outcome, not your own revenue.
Versus the broker-dealer standard, which is different.
Very different. Broker-dealers historically operated under the suitability standard.
Which means what, practically?
It means the product just has to be suitable for you. So think of it like buying a suit.
Okay, a suit.
Right. If you are a size 42 regular, and I sell you a size 32 regular suit that costs $5,000 and is made of gold thread, that is suitable. It fits you. It's not unsuitable like a size 32 would be.
Even if there was a size 42 suit right next to it on the rack for $500 that looked just as good and did the exact same job.
Exactly. Under the suitability standard, I have absolutely no obligation to show you the $500 suit if the $5,000 suit pays me a better commission, as long as the $5,000 suit fits your basic needs.
That's wild.
Now, if you are a 60-year-old retiree on a fixed income, I can't sell you highly speculative penny stocks. That's unsuitable. That would be like selling you a swimsuit for a blizzard.
Right.
But I can sell you a high-fee mutual fund that pays me a fat commission, even if there is an identical low-fee fund available from another company.
We are going to get into regulation best interest, or RegBI, in a moment, which was the SEC's attempt to fix this whole mess. But first, I really want to talk about how we got here. Because historically, the lines were much clearer, weren't they?
Much clearer. If you go back decades, right after the Investment Advisors Act of 1940, you had stockbrokers who sold stocks. You knew they were salespeople.
Right, they were selling IBM and General Motors.
Exactly. You paid a commission per trade. And then you had investment advisors who gave advice for a fee. Very separate worlds. But over the last 2 decades, the brokerage industry realized something very powerful.
What's that?
The title advisor commands trust. The title salesperson commands skepticism.
So they just started rebranding.
They shifted their entire model. They moved away from just selling stocks to wealth management. They started using titles like financial consultant, wealth advisor, financial planner. And the data really bears this out. Right now, about 45% of securities industry professionals are what we call dual registrants.
Dual registrants, that sounds very technical.
It just means they are registered as both investment advisor representatives and broker-dealers. They basically wear 2 hats.
So less than half the industry is picking a lane.
Correct. Only about 12% are strictly investment advisor representatives, the pure fiduciaries.
12%, that's so low.
Very low. And about 43% are strictly broker-dealers. But that 45% in the middle, the dual registrants, that is where the real complexity lies. because they can switch hats in the middle of a conversation.
Let's unpack that hat switching, because I don't think clients realize this happens physically or legally during a normal meeting.
They usually have no idea. Imagine an advisor sitting down with you in their nice office. They say, I'm going to build you a comprehensive financial plan.
Okay.
In that exact moment, they're acting as an investment advisor representative. They're a fiduciary. They are charging you a fee for the plan, and they are looking at your whole picture.
So as the client, I feel completely safe. I am with a fiduciary. I've paid my fee. Everything is above board.
Right. Then they present the plan to you in a nice binder. And page 10 of the plan says, to secure your income, you need this variable annuity.
And what happens legally right then?
Metaphorically, they take off the fiduciary hat and put on the broker-dealer hat to sell you that annuity. Under the broker-dealer hat, they can collect a commission. They are no longer held to the strict fiduciary standard of best interest at all times. They revert to the transaction-based standard.
But the client doesn't see the hat change. There's no bell that rings in the office.
No. To the client, it is the exact same person, same voice, same office, same cup of coffee. But the legal obligation has shifted entirely. One minute they were your advocate, the next minute they are a counterparty in a sales transaction.
Now, didn't the SEC try to fix this with RegBI? Regulation Best Interest came out in June 2020. I mean, the name itself implies that brokers now have to act in your best interest.
It raised the floor, certainly. It replaced that old suitability standard we talked about with the suits. RegBI requires brokers to act in the best interest of the retail customer at the time the recommendation is made.
Well, that sounds like a fiduciary duty. Best interest.
It sounds exactly like it, and the industry lobbied very hard for that specific name. But it is not a full fiduciary duty. The key distinction is that while RegBI requires them to mitigate conflicts, it does not ban commission-based compensation. It essentially just requires brokers to disclose their conflicts.
So if I disclose that I make more money selling you product A than product B, and I sell you product A anyway,
you have technically complied with RegBI. As long as you can argue product A is in the client's best interest among the limited products you offer, it is a disclosure regime. It doesn't eliminate the conflict at all. It just puts the burden on the client to read the fine print and understand that the conflict exists.
So they hand you a 70-page pamphlet that says we have conflicts, and that just absolves them legally?
In many ways, yes. It legalizes the conflict by documenting it.
And critics argue it lacks the ongoing nature of a fiduciary duty.
No, precisely. A true fiduciary has an ongoing, continuous duty to monitor your accounts and act in your interest. RegBI is strictly transactional. Once the sale is made, the duty effectively ends regarding that specific transaction. They don't have to call you 3 years later and say, hey, this annuity is no longer good for you.
But a fiduciary does.
A fiduciary absolutely does.
This brings us to the specific mechanics of how these conflicts actually bleed basis points from a portfolio. Because we talk about fees in the abstract a lot, but we really need to talk about where the money actually goes. We need to talk about 12b-1 fees.
Yes.
Which sounds like a droid from Star Wars, but it is actually a massive, massive revenue stream for the industry.
It is. It's named after the SEC rule that authorized them back in 1980. And the original intent was actually somewhat noble, or at least logical at the time.
How so?
The idea was to allow mutual funds to use a portion of their assets to pay for marketing and distribution.
The theory being, if the fund markets itself, it gets more assets. If it gets more assets, it creates economies of scale. And those economies of scale lower the trading costs and management fees for everyone.
That was the theory. In practice, it didn't really work out that way. Funds got massive, absolutely huge, but their expense ratios didn't always plummet. Instead, the 12b-1 fee evolved. It morphed into a trailing commission paid directly to brokers.
A trail. Explain how that works mechanically for the listener.
Okay, if a broker sells you a mutual fund with a 12b-1 fee, that fee comes out of the fund's assets, which are your assets. It is paid to the broker every single year you hold the fund.
Every year.
Every single year. It is usually around 0.25% for the service fee portion, but it can be up to 1 full percent annually when combined with distribution fees.
So it is essentially a recurring subscription fee you pay to the broker for the privilege of holding the fund, but it's hidden inside the fund's expense ratio. You don't see a line item on your statement saying broker fee, $250. You just see the fund return 6% instead of 6.25%.
Correct. It is a silent drag. And that drag is absolutely lethal over time. Let's do the math to make this concrete.
Please, let's unpack the numbers, because this is where it gets real.
Let's say you invest $100,000. And let's assume the market gives you a 9% gross return over 30 years. In scenario A, you pay no 12b1 fees, 0. In scenario B, you pay a 1% total fee drag.
Compounding works both ways.
Right. At 9%, your $100,000 grows to roughly $1.3 million over 30 years. Not bad. That is the miracle of compounding. But at 8%, with that 1% drag, it only grows to roughly $1 million.
That is a $300,000 difference.
It is. You lost about 25% of your potential ending wealth because of a 1% fee. And that money didn't just vanish. It wasn't burned in a fire. It was transferred from your retirement account directly to the distribution channel, the brokers and the platforms.
And the conflict here is obvious. If I am a fee-based advisor, remember the hybrid model we talked about, I might charge you 1% to manage your money and then put you in mutual fund share classes that pay me an additional 12b1 fee. So I am effectively getting paid twice on the same money.
And this is where share classes come in. This is exactly why when you look up a fund, you see letters after the name. A single mutual fund often has multiple share classes. Class A, Class C, Institutional Class, Admiral Class.
Right.
They all hold the exact same stocks. The portfolio manager is buying the exact same Apple and Microsoft shares for all of them. The only difference is the fee structure.
So an advisor could put you in Class C shares, which might have high internal fees paid back to the advisor, instead of institutional shares, which have almost zero internal fees.
Exactly. Under the old suitability standard, that was standard practice. It was just how business was done. Under RegBI, they had to justify it a bit more, but it still happens constantly. Or they might use a share class that does revenue sharing in a less direct way.
Which segues perfectly into revenue sharing and shelf space. Because even if it's not a direct 12b1 fee, money is still moving around in the dark.
Think of a grocery store. We all know that food brands pay the supermarket for premium shelf space.
Right. Eye level costs money.
Exactly. The end of the aisle, the end cap costs money. If you want your cereal to be seen by the shopper, you pay the grocery chain.
And the financial supermarket is no different.
Not at all. Custodians, which are the platforms where your money is actually held, and clearing brokers often charge fund families for access. If a mutual fund wants to be on the no transaction fee list, the NTF list, they usually have to pay the custodian a kickback.
So when an advisor recommends a no transaction fee fund, the client thinks, great, I'm saving $20 on a ticket charge.
But the fund is paying the platform, and the fund passes that cost right back onto you in their expense ratio. Or the custodian pays a portion of that revenue back to the advisory firm. It is a complete kickback loop. The advisor might recommend a platform or a specific fund, not because it is the absolute best performer, but because their firm gets a back-end revenue share or an expense offset from the custodian.
This is what they call the soft dollar economy.
Yes. Sometimes it's cash, sometimes it's services. They'll say, if you route your client trades through us, we will give you free research software or free admission to our luxury conference in the Bahamas. The client pays for the trade execution, and the advisor gets the perk.
And what is the SEC's stance on this soft dollar economy?
They have cracked down on the disclosure language recently. You used to see disclosures that said, we may receive revenue sharing. The SEC said, no, if you actually do receive it, you can't say you may. You have to be specific. But again, disclosure isn't prohibition. They just have to tell you it's happening, usually in a dense document you don't read.
Let's talk about the double dip of proprietary products, because this one is prevalent in some of the really large wirehouses and insurance-affiliated broker-dealers.
This is one of the most egregious conflicts out there. An advisor recommends a product, a mutual fund, or an annuity that is actually managed by their own firm.
So I go to Big Bank Wealth Management, and my advisor puts me in the Big Bank Growth Fund.
Correct. The firm earns the advisory fee from, let's say 1.25%, plus the internal management fee of the fund itself, which might be another 0.75% or even 1%.
They are double dipping on the exact same assets.
And the massive incentive is to keep assets in-house. Even if a third-party fund, say a Vanguard or a Fidelity fund, is performing better or costs significantly less, the advisor is heavily pressured to sell the proprietary product. And this pressure isn't always subtle. It can be explicit in their compensation grids, like sell $1 million of proprietary product, get a bonus. Sell $1 million Vanguard, get nothing.
There is also a lock-in risk here that people don't realize until they actually try to leave their advisor.
This is a nightmare for clients. Proprietary funds are often non-transferable.
Meaning what, exactly?
Meaning, if you try to move your account to a different brokerage, say you fire your advisor at Big Bank and try to move to a discount broker, The new brokerage literally cannot hold the big bang proprietary fund. Their system won't accept it. It is closed architecture.
So you have to sell it.
You have to liquidate it to cash. And if you have held that fund for 10 years in a taxable account, you are triggering a massive capital gains tax bill just to leave your advisor.
It is quite literally a golden handcuff.
It's a poison pill for client retention. It makes it mathematically irrational to leave a bad advisor because the tax hit from selling the proprietary fund is worse than the bad advice you're getting.
That is brutal. I want to circle back to the fee-only advisors for a second here, because we have painted them as the good guys generally, since they don't take these third-party kickbacks. But they aren't totally immune to conflicts, are they? We need to be balanced in this deep dive.
No, they absolutely aren't immune. And this is where we have to be intellectually honest. The most common fee-only model is charging a percentage of assets under management AUM, usually around 1%.
So if I have $1 million with you, I pay $10,000 a year.
Right. And the argument is always that this aligns interests. If the account grows to 1.1 million, the advisor makes more. If it drops to 900,000, they make less.
That sounds completely aligned. We both want the number to go up.
Generally, it is aligned. But there are specific scenarios where it creates a conflict known as the decumulation conflict.
Give me a real-world example of that.
Consider a client with a $200,000 portfolio and a $50,000 mortgage. Mathematically, paying off that mortgage might be the guaranteed best return they can get, especially if the interest rate is high or if the client just wants the emotional security of being completely debt-free heading into retirement. But if the client withdraws $50,000 from their account to pay off the mortgage, the advisor's billable assets drop from $200,000 to $150,000.
So the advisor takes a permanent pay cut.
At a 1% fee, that is $500 a year, straight out of the advisor's pocket. So the advisor has a direct financial incentive to recommend not paying off the mortgage, even if it is in the client's absolute best interest. They might argue, oh, you can earn more in the market, which might be technically possible, but their bias is undeniable. They're fundamentally disincentivized to shrink the billable base.
The same logic applies to annuities, right?
Huge conflict there. Let's say a 70-year-old client really needs secure income. A single premium immediate annuity, SSPIA, might be the perfect solution for them. You take a lump sum, buy an annuity from an insurance company, and get a guaranteed paycheck for life.
But an annuity is a contract with an insurance company, not an investment account the advisor manages.
Correct. Typically, once that money goes into the annuity, it leaves the advisor's billable AUM entirely. It falls off the platform.
So if I'm your advisor and I recommend you move $500,000 into an annuity to secure your retirement, I just fired myself from managing that $500,000. I lose $5,000 a year in fees.
Exactly. So fee-only advisors who charge on AUM have a natural built-in bias against products that remove assets from their management, like paying off debt, buying real estate, or buying annuities, even when those moves are mathematically correct for the client's financial plan.
So really, there is no perfect model.
No. Every compensation model has incentives. The commission model encourages churning accounts and high-fee products. The AUM model encourages asset hoarding. Even the hourly model encourages dragging out the clock on projects. The key is not to find a model with absolutely no conflicts, but to deeply understand the conflicts so you can spot when the advice is being driven by the math of the client or the math of the advisor.
Let's pivot to the investor context then. How do we actually spot this? Because most people just sign the huge stack of paperwork they are given during onboarding. It's like the iTunes terms and conditions. Literally nobody reads it. Where is the smoking gun?
The smoking gun is in the Form ADV.
The ADV.
This is the mandatory SEC filing for any registered investment advisory firm managing over $25 million. It is public record. It is not hidden behind a paywall. You can find it right now on the SEC's Investment Advisor Public Disclosure website. Just Google IAPD SEC.
And it has two parts. Break those down for us.
Part one is the raw data. It's very fill-in-the-blank style. It's highly useful for checking item 11, which is the disciplinary history.
So criminal records, regulatory fines, things like that.
Exactly. If they've been sued by clients or fined by FINRO, it is right there. If you see a yes in item 11, you stop what you're doing and read the details immediately. That is a non-negotiable step in due diligence. But the real goal, the narrative, is in part two. The brochure.
The brochure?
Yes. It is a narrative document written in plain English. The SEC actually mandates that it be in plain English. There are specific items you must read. Item 5 covers fees. It tells you exactly how they are paid and if fees are negotiable.
Wait, fees are negotiable?
Often, yes.
Yeah.
Especially for larger accounts. But if you don't read item 5, you might not know that. You might just accept the standard rate card.
Yeah.
Then you need to look at item 10. Other financial industry activities and affiliations. This is where they have to legally admit if they're also a broker-dealer or an insurance agent.
This reveals the dual registrant status we talked about earlier.
Exactly. If they're also an insurance agent, it says so right here. This tells you if they have that second hat in their back pocket. Then look at item 12, brokerage practices. This is where the dirty laundry of soft dollars and shelf space lives. This is where they disclose if they get research, software, or other benefits in exchange for using a certain broker or custodian.
And what about item 14?
Item 14 is client referrals and other compensation. This answers the question. Who is paying for the advisor's attention? Are they paying outside solicitors to bring in clients? Are they receiving compensation from non-clients? Because if someone else is paying your advisor, you are the product, not the client.
When we were reading this document, what are the specific red flags? You mentioned the word may earlier.
Yes. Legal teams love the word may. You'll see sentences like, we may receive compensation from third parties, or we may have a conflict of interest regarding proprietary products.
It sounds hypothetical, like it might happen, but probably won't.
It's not hypothetical at all. In the world of legalese, if they say they may do something, you should assume they're doing it. It is permissive language designed to cover actual behavior. If they weren't doing it, they would simply say, we do not accept third-party compensation. The word may is a shield. It means we are allowed to do this, and we probably will.
Also, you really need to verify the fiduciary status in writing, because a verbal yes during a sales pitch is not a legal contract. The ADV will explicitly state their registration status.
Absolutely. A salesperson can say, I put you first, and mean it emotionally. But a fiduciary contract means they put you first legally.
And on the portfolio side, if I'm looking at my statement right now, what do I look for?
Look at the share classes of your mutual funds. Just Google the ticker symbol. If you see Class C or Class A with a load fee, call your advisor and ask why. Ask why you aren't in the institutional or advisory share class. If you have $500,000 in a fund, you generally qualify for the cheaper share class. If you were in the expensive one, someone is getting paid the difference.
And check the cash, too.
Cash drag is a silent killer. Some firms automatically sweep your uninvested cash into a low-interest proprietary bank account.
This is the sweep account.
Right. They might pay you 0.5% interest on that cash, while they turn around and earn 5% on it in the institutional money markets. They are keeping the spread. It is another massive form of hidden revenue. If you have a large cash position sitting in a default sweep account, you are likely subsidizing your advisor's firm.
It's incredible how many layers there are to this onion. You think you're paying for advice, but you are actually paying for distribution, shelf space, marketing, proprietary product management, and cash spreads.
And that is exactly why the fee-only distinction matters so much. It doesn't solve the AUM conflict regarding mortgages, but it eliminates the vast majority of these third-party kickback conflicts. It cleans up the supply chain.
So we have covered the history, the mechanics, the hidden fees, and the regulatory landscape. It is a total minefield. But we promised the listeners a way to cut through all the noise.
We did.
It is time for the one question. If you are sitting across from a financial advisor, whether it is a brand new relationship or someone you have been with for 20 years, what is the one single thing you need to ask to clarify everything we just discussed?
The question is this. You look them directly in the eye and say, will you provide a written engagement letter stating you will act as a fiduciary at all times for all accounts and that you receive zero compensation from third parties?
Let's parse that carefully, at all times.
That is the crucial phrase, because a dual registrant, that 45% of the industry we discussed, cannot sign that letter. They can say they act as a fiduciary when providing advice, but they cannot legally say at all times because they need the flexibility to switch hats to sell commission-based products under their broker-dealer license.
And zero compensation from third parties basically kills the 12B1 fees, the revenue sharing, and the insurance commissions.
Exactly. It forces a complete binary distinction. Either they are a true fee-only fiduciary or they are not. There's no wiggle room. It cuts right through the fee-based confusion instantly.
Why does this matter so much?
It matters because clarity is the only real protection you have. If they won't sign it, it doesn't mean they're a bad person. It doesn't even necessarily mean they're a bad advisor. There are some decent brokers out there. But it means you need to read the fine print much, much closer because their incentives are not perfectly aligned with yours. You need to know you are entering a sales relationship, not just an advisory one.
So let's wrap this up. We've gone incredibly deep today. What are the main takeaways for the listeners?
Takeaway number 1, fee-based is not fee-only. It is a marketing term for fees plus commissions. Don't be fooled by the similarity. It is a specific classification designed to allow for hat switching.
Takeaway 2. Proprietary products and revenue sharing are invisible drags on your performance. They do not show up on your monthly invoice, but they absolutely show up in your long-term compounding. A 1% drag can cost you 25% of your total wealth over 30 years.
And takeaway 3. The Form ADV Part 2 is your ultimate source of truth. Read items 5, 10, and 12. Do not rely on the sales pitch, rely on the regulatory filing. That is where the bodies are buried.
Markets are generally efficient, but compensation structures rarely are. You need to know exactly what you are paying for, and more importantly, what you're paying via your returns.
If you don't know how your advisor is paid, you really don't know who they work for.
And that is the bottom line. Scrutinize your advisor's incentives just as hard as you scrutinize a company's balance sheet, and it leaves you with something to really think about. If compensation drives all behavior in finance, consider how the recent rise of zero-commission trading platforms and robo-advisors might be shifting these hidden costs somewhere even deeper. If the advice is suddenly free or algorithmic, who is programming those algorithms and what are their conflicts of interest? That's it for this deep dive. Talk Tickers out.